Good afternoon, everyone. This is David Blaine again. For those of you that didn't see my other video today, I made one on what's happening in the markets. But this video, I want to talk a little about what are called IBonds, inflation protected bonds issued by the U.S. Treasury. I've been getting a lot of inquiries recently, and I thought it would just be easier to make a quick video to explain, A, what they are, and number two is whether we think they're appropriate for investors to invest in. So the bottom line is they're actually a pretty good deal these days. The interest rate, the 6-month interest rate is 9.6% annualized. Now, it's a 6-month interest rate, and there's nothing wrong with them. They're a decent investment. They're a little bit difficult to deal with, which I'll get into in a minute. But the bottom line is nothing wrong with an IBond at all. In fact, we own their sister securities, TIPS, Treasury Inflation Protected Securities, it's a mouthful, in all of our portfolios. We believe in an allocation of TIPS. The IBonds were designed for individual investors, more like a savings bond, but an inflation protected bond. So what is an IBond? First of all, so an IBond is an inflation protected bond. It's issued by the US government, and they're designed to protect the value of your money from inflation. The I stands for inflation, inflation protected bonds. And so the interest rate that you earn on those bonds is a direct reflection of the interest, or I'm sorry, of the inflation rate that is happening in the economy over that current 6-month time frame. And so inflation is pretty high now. We've seen some eye-popping numbers. And so the amount that was paid the last 6 months from November through April, November 21 through April, was an annualized amount of 7.12%. And coming up from May, the next 6 months, the annualized rate is 9.6%. I mean, those are some eye-popping numbers for sure. And so we want to address this. You know, what are they, and are they good? So that number adjusts every six months. I'll show you in a minute when I share actually, I'll go ahead and do that now. So let's share the screen here and let's take a look at that. So IBonds have a fixed rate that they pay, and I have here, this is right from treasurydirect.gov. This is where you buy them, treasurydirect.gov. And the rates here on the screen go back all the way to 1998. So the fixed rate, 3.4%, you can see going down the financial crisis, 9/11, recessions, interest rates going down, 1%, 0%. It's been 0, 0.1, 0.2, 0, 0.3, 0.4, 0. So the fixed rate for these bonds has been very low for a long, long time. But it has a second component to it. So let's scroll to that, which is the inflation rate. Remember, I said these are for 6 months. So 6 months, 4.81 or 9%, 9.6 annualized. Last period, 7.12 annualized. But you can see before that, very modest 6-month interest rates. A lot of them in the 1%, less than 1%. Here was a negative one. As you go back in history, you can see just the interest rate, the inflation component of that interest rate, very, very low. So this is let me just say, this is a very unique time for IBonds in terms of the 9.6% this 6 months and 7.2 last 6 months. If you think that's going to continue, inflation at 7, 8, 9%, then these numbers will continue. If you think it's going to fall back to a more normal level, which I do at some point, maybe not in the next 6 months, but certainly over the next several years, we're not going to have 8, 10, 12% inflation for the next decade. It's not going to happen. If it does, we won't be worrying about all the stuff that we're talking about. Now, it can go much higher. It can stay higher for periods of time, but generally speaking, the rates are not going to stay that high, but for a year or two, generally speaking. Anyway, so back to the IBonds. Are they a good investment? Are they a bad investment? What's the deal with these IBonds? Tell us, should we buy some? I get these emails that say, hey, should I buy them? And The point is, it depends. There's some pros and cons. So some of the reasons to own them. Number one, it's an inflation hedge. It's a great inflation hedge. Is you can't lose money on an I-bond to inflation. In fact, they have a floor. You may have seen some negative numbers on the prior screen. Well, they won't actually charge you a negative inflation rate. So if we have deflation, they're not going to take money from your account. So by definition, they're an inflation hedge, just like stocks in the long run are inflation hedge, real estate, but the I-bond is a pure inflation hedge. And boy, that rate today is very appealing, certainly. Another pro, the returns are guaranteed by the federal government. Whatever you think about the debt level, I'm very concerned about our debt level and the way some politicians seem to be freewheeling with their spending and the new modern monetary theory, which I'm not a big fan of. The reality is in the world, the US is still one of the finest credit risks that you could take. If you're going to give your money to somebody, it's still a very good risk to take to give it to the federal government. So long term, I look at these I-bonds probably return, 2, 3, maybe 4%. I think is a better estimate of a long-term return for these. They're exempt from state and local taxes. As you may or may not know, our Constitution forbids states from taxing interest that the federal government pays. You can see that conflict of interest that may create. You do have to pay federal taxes when you redeem them, but they're a 30-year bond. So you could invest in them and they could mature, they could accrue interest. You can elect to have that interest deferred, or you can pay it year by year, but most people elect to have that interest deferred. And so it all comes due in 30 years when the bond matures or when you cash it in. As I already said, another benefit is the value of them cannot go below zero. So if we have deflation instead of inflation, their value is still guaranteed. It won't go below zero. All right, couple reasons we don't like, I shouldn't say don't like them, but what make drawbacks to them. Number one, lack of flexibility. So number one, you cannot withdraw your money within the first 12 months after purchase. And if you take the money out after before 5 years, you'll lose 3 months worth of interest. Okay, so can't take it out for 12 months. And if you take it out before 5 years, you lose 3 months worth of interest, which when you do the math, especially at lower interest rates, it really knocks the interest rate down significantly. I already said this, if inflation doesn't stay at the 5, 6, 7, 8% level, the returns are going to go down. And you saw on that chart I showed you, the returns of TIPS are very modest in normal times. I like inflation protected securities, but just recognize that the returns are very modest at most points. In fact, just to summarize that chart, I know it was a lot of numbers. It's been 12 years since they had a fixed rate of at least 1%, and it's been 19 years since they had a fixed rate of at least 2%. Okay, so these are not high flying type investments. Some of the other drawbacks, number one, you're limited to $10,000 per year per person that you can buy. These were designed for small individual investors and savers. Of course, like any government regulation, there's a way around it. Any tax law, if you get creative. So husband can buy some, wife can buy some. If you have a trust, husband trust can buy some, wife's trust can buy some. So we're up to 40,000. You can also take $5,000 in a paper I-bond, not electronic. They're going to mail you a paper bond. You can take a tax refund, a federal tax refund up to $5,000 in an I-bond. So there's $45,000. If you have businesses or LLCs or things like that with a separate taxpayer ID, they can also purchase $10,000. But each one of those entities has to have a separate account. You have to go to treasury.gov, treasurydirect.gov, and set up an account for each one of those entities. So if you want to go through that hassle to set up all those different accounts and everything, you can get, as a married couple, if you have trusts, $45,000 into them per year. And then if you have companies, you can layer it on top of that. But that's the other drawback, I guess. And, not to be self-serving, but if you're a client listening to this, we can't do this for you. Like, you can't hold these in your Schwab account. We can't set up the account for you. We can't do any of that. So if you want to do it, nothing wrong with it. Take the interest, put a little bit of money into it. Certainly let us know, but unfortunately we can't really assist with that. That's why we have the tips in your portfolio, the inflation protected securities that we can buy in your Schwab account. Anyway, so the bottom line is the current rate is very attractive. Longer term, expect more modest returns. If it's something you want to deal with on your own and set up the accounts and things like that, definitely support it. Longer term, the benefits, like all investing, is unknown. In fact, I may go ahead and set up my own Treasury Direct account. I don't like to recommend things I've never done before. And I have to confess, this is one of the things that I have not set up my own Treasury Direct account. I've been told it's kind of a cumbersome process sometimes, but I may go do it and let you know how it goes to see if it is really a giant hassle or not. But anyway, that's our take on IBonds. If you've got any other questions, please let me or your advisory team know. We'd be happy to talk about this further with you.